90% of traders lose their entire capital of trading within first 90 days. Not because the market was rigged against them, or not because they weren't smart enough, because nobody told them what market actually is before they put real money in it. I've spent 10 years teaching traders. I've seen thousands of traders come in and come out with nothing but scars. And the only thing that separated the ones who survived from the ones who didn't is this. The survivors built the foundation first. They didn't start fast, they started right. This video is the first step of that foundation, not to make you rich fast, to stop you from losing money you haven't lost yet. Let's start with something nobody explains properly. What is a market? A market is simply a place, digital or physical, where the buyers and sellers meet. One person wants to buy, one person wants to sell, and the price is born from that collision. When there are more buyers than sellers, price goes up. When there are more sellers than buyers, price goes down. Wrong. You may heard it from many gurus, but in a marketplace there are as many buyers that are sellers. For example, there are many buyers in a market and no sellers. There is nothing to sell to them. There is no sellers to have a transaction with them, even if they have all the money in the world. So there is no transaction taken place. Then what happens? Price goes up if buyers are eager to pay higher prices for an asset. And that's it. That's what a chart shows you, and nothing more complicated than that. This matters because all beginners think that the market is something that is working against them. And gurus use this irresponsibility to sell them courses about how the market wants to take their money. But the market is indifferent. It doesn't know you exist. It doesn't hunt your stop loss out of personal spite. It moves because millions of traders are making decisions simultaneously, and those decisions are what that creates price. The sooner you stop treating the market as an opponent and start treating it as a mirror of collective behavior, and especially your behavior, the sooner you'll start reading it accurately. Now, what's the difference between investing and trading, and why it is so important? An investor buys an asset and holds it for months, even years. Daily price swings are irrelevant to them, and traders exploit those swings. Traders buy and sell, sometimes within minutes, sometimes within days, and sometimes within hours. These are two completely different disciplines, and they don't mix. One of the most destructive habits a beginner can develop is entering a trade, start going red, then deciding to hold it until it comes back. That's not trading, and that's not investing. That's delusional hope, and hope is the most expensive thing you can carry into a market. The market is not your enemy, it's indifferent. It doesn't know even if you exist. It moves because millions of greedy people are making decisions simultaneously, and price is the result. When you lose, the market didn't target you. Someone else was better prepared. That's the only difference. Profitable traders understand the market. They don't fight it, and understanding starts with one simple fact. Price comes from the collision of buyers and sellers. Everything else, every indicator, every strategy, every system is built upon that single truth. If you don't have the foundation strong, nothing above it holds. Here's something most beginner educations skip entirely. The time frame you choose changes everything. A time frame is simply how much time each candle on your chart represents. A 1 minute candle shows you 1 minute of price movements, and a daily candle shows you the whole day. Simple concept, massive impact and implications. Different traders see the same market from completely different angles depending on their time frame. A scalper working on the 1 minute chart buys and sells in the time it takes a swing trader to decide whether to enter at all. A position trader holds for weeks, while a day trader already closed 10 trades. None of these approaches is wrong, but they cannot be mixed. The moment you start jumping between time frames looking for confirmation, you've stopped analyzing and started rationalizing by force. You're not reading the market anymore. You're looking for permission to do what you already decided to do out of greed and impatience. Here's the trap most beginners fall into. They open a chart, the 1 minute doesn't show what they want, so they switch to 15 minutes. The 15 minute doesn't cooperate, they use the 4-hour chart. Eventually they find a time frame that seems to confirm their idea and they enter. This isn't analysis, it is bias hunting. And the market charges a very high price for it. Your time frame needs to be chosen before you open your chart, based on your schedule, based on your psychology, and the time you can actually dedicate to watching the price. Not based on where you happen to find a setup today to satisfy your itch. One of the most common and dangerous beginner mistakes, switching your time frame until you find a signal. The 1 minute doesn't show you what you want, switch to 15 minutes. That doesn't work either, try the 4 hour. Eventually you find something that looks like confirmation and you enter. But that's not analysis. That's bias hunting. You already decided what you wanted to do. You just kept looking until you found something that agreed with you. A professional trader chooses their time frame before even the session starts because their style fits their life. Not because they found a setup somewhere and they need a reason to take it. The time frame doesn't follow your idea follows your time frame. Now let's talk about tools. In the trading industry, the most important skill you should have is survival. So don't buy a $4,000 PC. Just an old laptop or a tablet can do the job. TradingView is where you start. It is a web-based charting platform. The free version is enough for everything in this series. So you don't need to pay anything right now. Open it, find your market, and look at a clean chart. And this may be the most important thing that I'm telling you in this episode. Keep your charts clean. I know that sounds counterintuitive. You've probably seen charts covering RSI, MACD, Bollinger Bands, stochastics, 3 different moving averages, and something called an Ichimoku cloud. And you thought that looks like expertise. That's so cool. It isn't. It's noise. Every indicator is derived from price. So they don't predict anything. They describe what already happened with a delay. By the time an indicator gives you a signal, price has already made its decision. The traders who are actually profitable tend to have the cleanest charts. And the traders who are still losing tend to have dashboards that look like the cockpit of a commercial aircraft. More information doesn't produce better decision. It produces confusion and paralysis. A line tool and a horizontal level tool, that's your starting kit. Everything else comes later and when you really understand why you are using them. Not because you've seen it in a 30-second YouTube short. The more indicator you add to your charts, the more confused you'd get, not the more prepared. Every indicator is derived from price. They tell you what already happened, not what will happen. When a signal fire, price has already decided. Clean chart, clear mind, precise decision. This is a principle, not a preference. The traders who actually make money tend to have cleaner charts. The traders who blow up have dashboards that look like a flight control panel. Complexity may feel like preparation, but in trading, it is actually procrastination dressed up as analysis. Keep it simple, not because simple is easy, because simple is the only thing that can work under pressure. We've covered what the market is, how time frame works, and why a clean chart beats a complicated one every time. If it has been useful, hit like, not for me, but because YouTube shows this to the people who actually need it when you do. If you have a question, drop it below, I'll read them. Let me end with the thing most beginner content refuses to say. Why do 90% fail? Because they skip this part. They watch one video showing someone turn $1,000 into $5,000 in a week. They join a Telegram signal channel with a claimed win rate of 80%. And they feel like if they wait any longer, they will miss something. Then they open a live account before they even know what they are doing. The market is open 5 days a week around the clock. It isn't going anywhere. Opportunities don't expire, but capital you lose doesn't come back. That asymmetry is the most important thing a beginner needs to understand, and almost nobody explains it. Because if they do, they don't sell. The 10% who survived, they weren't smarter, they weren't luckier. They were more patient, they built the foundation before they put the money on the line. This series exists to build that foundation for you. Next episode we go into something that sounds basic but destroys more trades than almost anything else. Order types, market orders, limit orders, stop orders. Get this wrong and the clean setup becomes a losing trade even before the market moves against you. Subscribe if you don't want to miss it, it's free. And if the next episode saves you from one bad entry, it was worth the 30 seconds it took to hit the button.